We'll be talking about the real reasons to own gold, as well as some of the quote-unquote unreal reasons to own gold, with two experts who have been regulars on our show, very knowledgeable people on the gold and precious metals markets at large. They are Jeff Christian, CPM Group Managing Director, as well as Gary Wagner, editor of thegoldforecast.com. And we'll be talking about gold from a more fundamental and technical perspective today. The idea of this discussion today is to give the viewers a primer on the gold market, everything you need to know, basically, in 30 minutes or less about gold, why you should hold gold, how it performs relative to other assets, and how it performs during different economic cycles. Welcome to the show, gentlemen. It's good to have you both together on a panel. I've never had you both on before. It's a real treat to have you.
Thank you for having me.
Okay.
Yeah, it's great to be here.
Okay, so let's start with macro news first and foremost, and then we'll get into some of the more academic discussions, shall we say. The Federal Reserve is slated for a 50 basis point hike in the next meeting. At least that is the consensus estimate. Do you agree with the consensus estimate? Let's start with you, Jeff.
It's most likely that they will do that because that's what they've been signaling. And I think that they would rather stick with their signals than give strange message by changing their tune. So yeah, we're looking for a 50 basis point increase in the middle of June.
Okay, and Gary?
I agree. I believe that what the Fed wants to do is have some kind of sense that what they say is what they will do. They talked about taking a 3/4 or 75 basis point rate hike off the table, but they've talked about leaving it open-ended. In other words, I believe that the Fed will continue to raise rates by a 0.5% or 50 basis points for the next couple of FOMC meetings if they believe that inflation is not really ticking down and they're not really seeing any kind of major change.
Okay. This comes as the Bank of Canada today on Wednesday raised their interest rate, their benchmark rate to 1.5%, in line with most analysts' expectations. Now, Jeff, let's start with you. It seems like central banks around the world are tightening. It's not just the U.S. Fed. The Bank of Canada, for example, like I just said, the gold market did not respond negatively today to the Bank of Canada's decision. Gold is somewhat flat, slightly in the green. But the point is, you would expect higher interest rates to really weigh down on gold. We've been trading in this range of $1,800 to $1,900 an ounce for quite some time. I mean, it's not strong by historical standards in the sense that we had seen higher gold prices earlier in the year. But given that interest rates are rising, some might say faster than expected, one might speculate that gold should be trading even lower. So how would you characterize gold's reaction so far to the interest rate hikes that we've been seeing all around the world, Jeff?
I'm not surprised that gold hasn't overreacted. I mean, if you had asked me before, I think that there is an undue fear of rising interest rates, not only in the gold market, but in the broader financial markets. I mean, you have to put into context what the past 50 basis point move by the Fed means, what the future 50 basis point move and subsequent ones are, and what the Bank of Canada does. I mean, you still have historically low interest rates. We've moved off of the bottom from 25 bips to 1.1% for 90-day T-bills, but we have very low nominal rates. We have a long way to go before you start seeing those interest rates putting a brake on demand. And we'll probably talk later about the supply side of the economy and fiscal policy. Yes. And you also have negative interest rates in an inflation-adjusted basis. So from a perspective of the effects of the interest rate increases on gold prices, I wouldn't expect a major negative impact on gold prices. In addition to that, the increase in interest rates reflects concerns about inflation, which are positive for gold prices, and the increase in interest rates and the high inflation and the whole mashugala that goes together that's causing the interest rates to rise is generally characterized as volatility and uncertainty about the economic environment. And in that kind of environment, people turn toward gold. So the rising interest rates, you can argue, actually are positive for gold. And then when you look at the historical correlation, 1968 to the present, the correlation between T-bills and gold is zero. I mean, there are periods of time when they're both rising. There are periods of time when they're moving in opposite directions. And there are periods of times when they're both falling. So I think there's an overemphasis on interest rates based on the historical relationship between interest rates and gold and where interest rates actually are today.
Okay. Gary, I'd like you to respond, please. And of course, talk about your research and what you have found over your many years of research on the gold market, the relationship between gold and interest rates. What is it?
Well, first of all, the first thing that I do want to discuss that is noteworthy is the fact that we have a pendulum swinging in terms of market sentiment, because higher inflation, of course, is going to drive gold prices higher. It's going to give it bullish undertones and the market sentiment will shift. However, when the Federal Reserve comes in and addresses that by raising rates, that has a negative impact. The other thing that I find is absolutely noteworthy is beside raising rates, we not only tapered the asset purchases, the Federal Reserve, but they are now liquidating parts of their asset sheet and reducing their balance sheet. And that has the same net effect as raising rates. So while they might raise rates by 50 basis points at the next FOMC meeting, each and every month, they are letting their mortgage-backed securities as well as their treasuries just come to fruition, and they're not re-upping them, so to speak. In other words, they're reducing their balance sheet. So you've got both of those putting a strong effect on the demand side because it's more expensive to do business, it's more expensive for goods. The other thing that is very important to me is that market sentiment, as I said, keeps shifting back and forth, where you will see that on some days investors are real concerned about the rate of inflation, other days the rate of interest rates. And that seems to swing back and forth, and that's what's giving us our volatility.
All right. Let's go into this then and talk about the use cases for gold. Russia has been, I've been reading headlines that Russia has been quietly making the case for owning gold. The leader of the parliament, Zavani, has said that, and I quote, if people want to buy Russian resources like oil, gas, he says, let them pay it either in hard currency, and this is gold for us, or pay as it is convenient for us. This is the national currency. I think that's a rough translation from Russian, but I think what he's saying is you can either pay with your local domestic currency, lira, yen, whatever that may be, or with, I guess, gold. Is gold making a comeback around the world as a form of currency, as a form of payment in the public sector? I'll start with you, Jeff.
No, I think that's a Russian pipe dream. The reality, they said that when they first attacked the Ukraine and sanctions started being applied. And the reality is that no one is actually paid in gold or in fact in rubles for the most part. So what you saw was this sort of face saving thing where, okay, Europeans can pay Gazprom Bank in euros, and then Gazprom Bank will promptly take those euros and buy rubles. And that's what supported the ruble. It was Gazprom Bank, a Russian bank, converting the euros that the Europeans were paying for in their gas. The reality is that most of their contracts are specify that the buyers of their oil and gas pay in ruble or euros or dollars. And when the Russian government said, oh, you have to pay in rubles or gold, the other side of the contract said, no, that's not what the contract said. And then when you go to other countries, I'm not quite sure what India's paying with, but I do know that, like with China, where the Russians had several hundred, I guess they had about more than $100 billion in deposits from the central bank in yuan deposits with the People's Bank of China. When they asked for that money back, the People's Bank of China said, sorry, we don't have sanctions against you, but there are international sanctions against you and anybody who deals with you. And therefore, we don't feel that we can give you your money back at this time. So I'm not quite sure. I mean, it looks like a pipe dream. Yeah, well, this is great. You're going to pay for us our oil and gas with rubles or gold. But the reality is no one's actually doing it.
Yeah, well, Gary, I will get your opinion on this, but just to follow up, Jeff, you've heard of the news that Russia recently fixed the price of their rubles to gold, 5,000 rubles to 1 gram of gold, to be exact. What's this all about?
That's an inaccurate thing. What they said was in the initial days of their invasion of Ukraine, they said that they would buy gold from domestic refiners and producers at 5,000 rubles per gram. And no one was selling it to them because at the time they had closed the banks within Russia, and there was this tremendous demand for gold from investors within Russia. And they were paying a premium to the world price. The 5,000 ruble per gram price was a discount to the international price. So the refiners were saying, why would we sell to the central bank at a discount? You know, all due respect to patriotism and all that stuff, when we can get a premium by selling to investors. So after about a week or so, the Central Bank of Russia actually pulled back and said, no, we will buy gold from domestic producers and refiners from at a negotiated price relative to the international price. So they never, ever said they were fixing the gold price at 5,000 rubles per gram.
I'm reading a bunch of...
Anybody who says that to you either doesn't understand what they're talking about or they're consciously trying to mislead people.
I'm confused. Okay, so let's set the record straight, because I'm reading a bunch of headlines that specifically say, and they're quoting other people, that the Russians are pegging, quote unquote, the ruble to gold. I mean, there's no peg. There's no peg.
There's no peg.
Okay. All right. Well, thank you for clarifying that. That's been definitely circulated on the...
Anybody who says that the Russians are trying to peg gold to the ruble at 5,000 rubles per gram.
Well, other way around.
Either they don't understand what the Russian central bank was saying 3 months ago, and the fact that they got rid of that within 2 weeks, or they're consciously trying to mislead Western investors into thinking that we're going back to some ruble gold standard.
Maybe it's that was my question at some point. Maybe got lost in translation between Russian and any other language. But anyway, all right. So moving on, Gary. My broader point being that is gold currently or in the future about to make some sort of comeback as being used as a monetary metal, in the sense that it is being used as a currency, whether it be backed, whether we have fiat currencies that are backed by gold, right? Which is essentially what the Bretton Woods was, or we have actual just payments in the private sector made with gold or gold-backed tokens. There's a lot of talk about Bitcoin, for example, being used in our everyday transactions. I'm not seeing the same headlines with gold. Is that going to make a comeback anytime soon? And if not, why not?
I believe that would be hard to an impossible task. Realize that for hundreds of years here in the United States, we were on a modified gold standard. That was changed with Roosevelt when he confiscated all of the gold. Gold was sitting at around $20. A year later, he raised it to $35. But the reason he could do that is we were now the single largest holder of gold of any country in the world. It really maintained at that level up until World War II, then Bretton Woods, and then Nixon came in, I believe, 71, and dissolved that agreement. And the agreement was basically that other countries could turn in US dollars and receive gold for it. Now, can we go back to some kind of modified gold standard? Possibly, but an actual gold standard, I don't believe that there's any country that has the ability to back their currency dollar for dollar, let's say, with gold. That would take way too much gold if you look at what the amount of currency within the system. Mm-hmm. So I think that that's a fantasy that we can get a return to a gold standard per se by any country. In terms of a digital gold currency, again, it depends on the amount of currency that are digital coins that are released and having gold to back it. If it's paper gold, that's completely different than physical gold. And I think that that's a hard sell at best, to be honest.
Jeff, just one note, and I'll move on to some other topics.
Yeah.
Gold standard, you and I have talked about this before. A lot of gold investors I've talked to gold bugs, if you want to use that moniker, they believe that a gold standard is not only necessary, but also on its way. Have you come across in your research any such murmurings from authorities, central banks, governments, that they're thinking of adopting a gold standard similar to what we already had in the past? And share your insights as to whether or not this may be necessary.
Yeah, I don't know any central bank that's talking about a gold standard. And one of the things to remember, like as Gary was talking about, in 1967 and the first 4 months of 1968, the United States was on a gold standard. You could, at that time, you could be a private entity as well as a central bank. You could bring dollars to a US nationally chartered bank or to the Treasury directly. They literally had windows in the directory. You could bring your dollars in and exchange them for gold, physical gold, at $35 an ounce. And in 1967 and the first part of 1968, there was such a rush to buy gold at $35 an ounce, mostly by Europeans who had been allowed to own gold then for the first time since World War II. We lost like 75 or 80 million ounces of gold in a 15-month period. So that in April of 68, Lyndon Johnson closed the private sector gold window, and then Nixon closed the government central bank window in 71. So and central banks have a sense of history. So they say, okay, so let's say that I go to a gold standard and I make my currency convertible to gold. What's happened in the past? Well, in the 1960s, the US lost 60, 70 million ounces of gold, at a fixed price. Prior to that, there were runs on the Bank of England when they had a gold standard that was, where the pound sterling was convertible to gold. Prior to that, the Banque de France had a convertible franc, and they lost a lot of gold. So I think central banks look at it and say, no, that's not something. Then they go forward and they say, it doesn't make sense to us to have a gold standard. Now, in 2015, the Bank of China said, listen, from the 1940s, when the communist government took over China until 2015, we, the People's Bank of China, has always said that gold is a small and insignificant part of our monetary reserves. And we're changing our policies. We've actually bought some gold domestically. I think it was about 12 or 14 million ounces. We're adding that to our monetary reserves. And in the future, gold will be a small but significant part of our reserves.
Right.
So they've said, yeah, we think that diversifying our portfolio or our monetary reserves to include gold as well as other foreign currencies and move away from the dollar is important. But it's not like we're moving wholesale away from the dollar to gold. And if you look at monetary reserves, you still have 60% of the foreign exchange reserves held by central banks collectively in US dollars. So I don't know any central bank that's talking about using gold in a future monetary international currency regime.
Gary, there's this theory that should we have a gold standard, again, that would solve a lot of our inflation issues, that somehow anchoring a currency, any currency, to gold should, in theory, make the prices of that country, the domestic prices of that country, a little more stable. And people point to the fact that right after 1971, when Nixon took us off the gold standard, we had inflation in the double digits, rise shortly after that for, a number of reasons, but still that may or may not have happened had Bretton Woods just been kept. What do you think?
Well, to me, the definition of fiat currency is currency not attached to any real asset. So absolutely, the fact that we have currencies that are backed by the faith in the government is quite different than what Jeff was just talking about, which was a gold or silver certificate that you could take in and redeem it for gold. As soon as you took currency and made them, in essence, worthless, they're backed by the government, they're backed by your faith in that government, you changed the dynamics of that currency. And once that box was opened, it can no longer be shut, so to speak, unless you would go back to some sort of modified gold standard. Because as I said, to go to a full-fledged gold standard, dollar for dollar, ruble for ruble, yuan for yuan is close to impossible because the amount of gold needed. Now, the key right now is that by attaching a currency to an asset, such as gold or silver, limits the amount of currency that you can print. You can't print more than is covered by the asset, the underlying asset. And so, of course, that would give that currency more intrinsic value or give it intrinsic value, which I don't believe the fiat currencies have. Mm-hmm. And as long as we continue I believe it's an experiment. Once we went off the gold standard, we don't know what the end game is yet. And I think that as I said, it's virtually impossible to close that box now that we've gone off of a gold standard to move back towards it.